Hello and welcome to this Primary Markets webinar for Systematic Alpha Management. Today we are hosting Peter Camberlin of Systematic Alpha, who's the CEO, to further outline the fund and the opportunity. Today's format is a familiar one, a 5 to 10 minute presentation. As a reminder, obviously this has been recorded. You can always come back to have a review of it later on. And so without further ado, I'll hand over to Peter. Good morning.
Good morning. This is Peter Camberlin. I'm the CEO of Systematic Alpha Management. We are a hedge fund manager that is specializing in trading liquid regulated futures markets on major exchanges. We trade across all asset classes, equities, currencies, commodities, and fixed income markets. And last year, when regulators in the United States approved Bitcoin futures, we decided to put together a separate investment vehicle which will be focusing on trading Bitcoin futures. Systematic Alpha has been in business for well over 15 years, and over the last 10 years, we were recognized 5 times as the best short-term manager, or CTA. We specialize in short-term trading strategies that are fully systematic, that trade around the clock, and that respond to price changes in less than a second. So we are using our skills, our infrastructure that we developed over the years, and our knowledge how to backtest trading strategies on the new asset class, which is cryptocurrencies. And once again, we are focusing exclusively on trading regulated futures markets. The advantage of trading futures over the counter exchanges is from the operational risk standpoint. Futures trading carries virtually no operational risks. We have no counterparty risk or very little counterparty risk. We have no issues related to custody of the cryptocurrencies. So no risk of exchange going down or not being able to get your money back. So from the operational risk standpoint, there's a big advantage of trading futures. From the trading standpoint, futures allow us to take both long and short positions, and clearly this year cryptocurrencies have been in a bear market, and ability to go short has allowed us to generate positive returns this year, despite the fact that major cryptocurrencies, including Bitcoin, are down anywhere from 30 to 50% or more. So we started trading our fund on February 1st. The fund has institutional setup. We have a very well-known administrator, SS&C Technologies, which is calculating daily NAVs for us. These daily NAVs are reported directly to Bloomberg. KPMG will do the audit of the fund. Fund has weekly liquidity, no lockups, and a minimum of 100,000 to invest. Now, speaking about the strategy, we are using our proprietary trading strategies that are looking to place momentum trend following signals when Bitcoin futures market is breaking through either high local prices or low prices. So the style of trading that we implement is trend following momentum trading. We analyzed Bitcoin data series. We used 4 years of data from cash exchanges, OTC exchanges, and we reconfirmed that this particular asset class has very strong momentum trend following properties, and that is why we're trading trend following strategies. Now, we are not probably smart enough to know where Bitcoin will be trading in a month, in 3 months, in 6 months, or in a year. We are projecting prices forward for a few days only. And we're basing our decisions whether to go long or short based on the local momentum. If the prices are moving higher and Bitcoin is breaking through some local high levels, it's a signal for us to go long. If on the other hand, prices are going down and Bitcoin is breaking to the low levels, it's a signal for us to go short. And we expect that move either up or down to last for some time. And the reason this particular market is so, so trend following in nature is because for the most part, retail people, retail investors are participating in the OTC exchanges. They are the ones who are driving the prices either up or down, and their typically response time to events is delayed. So after an initial, let's say, negative news, cryptocurrencies are dropping, and then there is continuation of the drop because all the retail people, they will be selling on a negative news, but with some delay response. Our advantage, of course, is that we have, fully automated execution. We have a response time of milliseconds, so it's very quick. So we are the first ones to be positioned on the right side of the market. And since February 1st, we so far have generated positive returns. At the end of May, in the first 4 months of operations, we were up close to 16% net of fees, while at the same time, Bitcoin market over the same interval was down approximately 25%. Correlation to Bitcoin on a daily level is very low positive. So our goal as the manager basically is to generate positive returns irrespective whether Bitcoin is moving up or down. The best environment for us is when volatility is very high and when Bitcoin has substantial moves, more than 10% in either direction. If it goes down a lot, we will make money. If it goes up a lot, we will make money. The worst environment for us, on the other hand, is when volatility is very low and Bitcoin is trading in a narrow range. That would be a detrimental environment for us. And quite frankly, over the last month, it's been the most challenging environment so far since we started trading the fund back in February 1st of this year.
Okay, get it, Peter. And understanding you're very much leveraging the volatility in the market for obviously a pretty new instrument. Just to give us a bit of an overview then on the risk management.
Yes, so on the risk management side, first of all, the fund has no leverage. Futures on Bitcoin, they are quite unusual, and our prime brokers require us to post 100% margin when we trade these futures. So by definition, we cannot have leverage. We pay full cash for whatever notional exposure we have in the fund. Moreover, we have some additional internal restrictions on the usage of cash. Our maximum long exposure is 2/3 of the account's size, cash or equity, and our maximum short exposure is only 50% of funds equity. So no leverage, number one. Number two, every time we establish a position, we have a trailing stop attached to it. The way it works is, let's say we have a long position and we have a trailing stop, let's say 6% away from the entry price. If prices are immediately moving down after we enter the long position, the maximum that we can lose is 6% on that trade. However, if prices are fluctuating and let's say market is moving higher in our favor, the trailing stop would be moving higher as well because it's attached to the latest high price. And the goal, the idea of the strategy is that at some point, the trailing stop moves above the entry price, and then from that point on, it's just a matter of how much money we're going to make, a little bit or a lot. On the upside, we actually do not limit ourselves. So if the Bitcoin, quadruples in price in a straight line, we will participate in all those gains. We have no limit on the upside. The other risk management tools that we use, if we are in a drawdown of about 15 to 20%, we will deleverage risk. Overall, we will trade much less exposure. I already mentioned a little bit about the operational risks. We believe that one of the main advantages of trading futures is that we have virtually no operational risks. So from that standpoint, any risk manager that looks at our fund should be, happy and satisfied.
Yeah. Okay. Fantastic. I think that really nicely encapsulates the fund and what it's attempting to achieve. Just as a summary, Peter.
Well, as a summary,
and how,
we are
also the current size of the fund.
Yes, the current size of the fund, we're trading 6 million cash, which we raised from a lot of different investors. Actually, we have 25 individual investors. Some of these investors are high net worth, some of these are family offices, wealth advisors. We also have a crypto fund of funds invested in our fund. So we have a very diversified client base. We do have a limited capacity. The capacity of the fund is anywhere between $30 and $40 million. It's related to the fact that futures have limited liquidity still compared to the cash exchanges. And that is, by the way, one of the main reasons why this opportunity is so interesting, is because the institutional participation in this asset class, in the crypto asset class, is still very, very low. Retail participation is very, very high, and that makes this market so unique and special. It makes it liquid enough for us to trade on one hand. On the other hand, it's immature and less efficient.
And anyone who's reviewing this, there is obviously a more detailed information deck available to learn more, and obviously can organise for you to talk to Peter or one of the team. So thanks again, Peter, and we'll look forward to talking to you soon.
Sounds great. Thanks a lot.